Ladies and gentlemen, I'm very proud to introduce Mr. John Allison.
Thank you. Good afternoon. It's really a pleasure to be here. I always enjoy talking to bright young people who will be future leaders in our society. As was just noted, my focus of this conversation will be on the Great Recession and the ensuing failed economic recovery and the financial crisis that created that phenomena. I do wish I had a more fun subject to talk about, but it is a really important subject. It's a really important subject not only because of the economic policy implications, but because of the broader policy implications and decisions that are going to impact the quality of all of our lives for a long period of time. I have 5 basic themes. First, the financial crisis was primarily caused by government policy. We do not live in a free market in the United States. We live in a mixed economy. The mixture varies a lot. Probably the least regulated industry is technology, which is maybe 20% government. The most regulated industry is financial services, which is probably 70% government. It's not surprising that the most regulated aspects of the economy is where we had the biggest problems. Secondly, government policy created a bubble, a massive misinvestment in residential real estate. That bubble burst, as all bubbles do, destroying trillions of dollars of wealth and also destroying millions of jobs. Thirdly, a number of financial institutions made some very serious mistakes, big institutions and small. In my view, those companies should have been allowed to fail. However, their mistakes were secondary and in the context of government policy. Fourthly, almost everything we've done since the crisis started will reduce the quality of life and our standard of living forever. We've made a lot of serious errors in terms of improving our long-term productivity. And finally, and interestingly enough, while there were a number of economic problems, the real cause of the financial crisis and the real cure are philosophical. What happened? We invested at least $3 trillion, maybe more, too much in residential real estate. We built too many houses, too big of houses. We built houses in the wrong place. We should have been investing in technology, in manufacturing capacity, in education, in agriculture. We should have saved more, and we should have spent a lot less. We should have borrowed a lot less from foreigners. This misinvestment was particularly destructive for a couple reasons. First, housing, while we might individually think of a house as an investment, housing is consumption. We consume housing. It's not like a manufacturing plant. So once the house is built, it doesn't create any new jobs going forward. So we actually made a huge, massive misinvestment in consumption instead of in production. Secondly, we taught a lot of people how to do the wrong thing. For 15 years, we had this housing boom, and a lot of people learned how to build houses. We drove a lot of jobs overseas because wage rates in construction rose manufacturing rates in the U.S., and manufacturing jobs got priced out of the market, and now we can't get those jobs back. So this is not just the destruction of wealth, it's the destruction of productivity, it's the destruction of people's ability to produce and create. How did we make a mistake of that magnitude? 3 primary culprits: the Federal Reserve, the FDIC, the Federal Deposit Insurance Corporation, and government housing policy, specifically Freddie Mac and Fannie Mae, the giant government-sponsored enterprises. Let me talk about each one of these entities. The fundamental cause of the financial crisis were errors made by the Federal Reserve. Something that people that study economics know, but a lot of people don't understand, is in 1913, the monetary system in the United States was nationalized. We do not have a private monetary system. The government owns the monetary system. You can't go out and print your own money, right? The government owns the monetary system. If you're having problems in the monetary system, by definition, they're government problems. If interstate highway bridges were falling down, people say, well, the government owns the interstate highway bridges. They're falling down. The Federal Reserve was created in theory to reduce volatility in the economy. Unfortunately, what the Federal Reserve actually does is reduce volatility in the short term and create bigger problems in the long term. Why is that? In a free market, we as human beings are not omniscient, so free markets are always correcting. New businesses are being created, businesses are failing. that corrective process is very productive because it allows us to reallocate resources. When you take out the downside of the correction process, all you do is push problems into the future. It's analogous as if you don't discipline your children. You get the long-term consequences. And that's what the Federal Reserve is. By trying to moderate the natural corrections in the economy, they push them out and make them much worse into the future. In addition, the very existence of the Federal Reserve allows the federal government to leverage dramatically. And since the Federal Reserve was created, leverage by governments in the United States, and specifically by the federal government, has grown exponentially. Why is that? A state, California, can borrow you a lot of money because they can tax people, but they run into a limit someday, and California's probably run into that limit. On the other hand, the federal government can borrow you a whole lot more money because not only can they tax, they can print money. And when you can print money, it's a huge temptation to borrow, particularly when the politicians decide whether you're going to print money or not. And we've had a dramatic increase in leverage since the creation of the Federal Reserve. And then we had some very specific errors made by the leaders of the Federal Reserve. Alan Greenspan, who was heading the Federal Reserve from the mid-1980s till a few years ago, wanted to be the maestro. He wanted to be the hero. He didn't want to have any bad times when he was running the Federal Reserve. So in the early 2000s, he created what's called negative real interest rates. What that means is inflation was higher than the interest rate. So inflation was running 3%. You could borrow money at 2%. You cannot create a more dramatic incentive to borrow than that. And then secondly, Bernanke, the current head of the Federal Reserve, when he took over the Federal Reserve, inverted interest rates. Now, what does that mean? Inverted interest rates are where short-term interest rates are higher than long-term interest rates. That is not a natural phenomenon. It never occurs in markets. Only the Federal Reserve can do that. Why is that? Because people, if you invest long, you want a higher return because it's riskier and it's less liquid than you do when you invest short. And banks basically make money by borrowing short and lending long. If you invert the yield curve and create negative short-term rates that are higher than long-term rates, banks' margins literally go negative. That means we're buying watermelons for $10 and selling them for $8. What that does is create a huge incentive for banks to take risk. Because the banking business is a funny business. You can get higher returns, higher interest rates by taking more risk. And if you look at most of the bad loans that were made during this period of inverted interest rates. And Bernanke had the longest interest rate inversion in U.S. history, and he incented a lot of high risk taking. At the same time, the Federal Reserve economists and Bernanke himself were constantly saying this was not going to create a recession. So not only did he give this incentive to take risk, he said, oh, everything's going fine, no reason not to take risk. In a certain sense, well, in a fundamental sense, we couldn't have had a bubble unless the Federal Reserve provided the money. It's not mathematically possible. So the fundamental cause of the bubble was the Federal Reserve. Secondary factor was the FDIC, the Federal Deposit Insurance Corporation. Now that sounds like a good thing, having your deposits insured. However, it destroys market discipline. Tell you how that works. I'll give you a concrete example. BB&T took over a failed bank in Atlanta. Lots of banks failed in Atlanta. And it's a very typical story. As 10 guys in the motel business raised a little capital, leverage that capital dramatically by paying high interest rates on certificates of deposit, lend that to their cronies in the motel business. Those cronies go broke, and that community bank failed, and the FDIC lost 50 cents on the dollar. On a bigger plane, large financial institutions that failed, Countrywide, Golden West, Washington Mutual, IndyMac, all financed high-risk lending operations using FDIC insurance. Without FDIC insurance, the depositor would have cared about the financial strength of their institution. With FDIC insurance, hey, the government guarantees your deposits. You don't even think about how strong your bank is, and they finance those operations using FDIC insurance. The proximate cause of the financial crisis was government housing policy. And this goes back a long time when the government has tried to raise the home ownership rate over what's called the natural market rate, under the theory that home ownership is a good thing. Well, home ownership is certainly a good thing in one context. However, there's no evidence that owning a home per se changes human behavior. In fact, the evidence is the opposite. The set of characteristics that allow you to be a homeowner, the discipline, the savings, is why you see more success rates in people that own homes. So giving somebody a home does not, in fact, change their behavior. We've been incenting increases in home ownership for a long time, which, by the way, is incenting consumption versus investment, right? Well, we've been incenting consumption of houses for a long period of time. We've done it with the tax laws. We've done it with what's called the Community Reinvestment Act. But interestingly enough, the big event was a decision made by Bill Clinton in 1999, and I was CEO of BB&T, and I remember this well, where he set a goal for Freddie Mac and Fannie Mae, these giant government-sponsored enterprises, to have at least half their loan portfolio in what's called affordable housing, now subprime lending. A number of economists, and this was actually reported in the New York Times, interestingly enough, a number of economists, including liberal economists, said, wow, that's risky. The legitimate affordable housing market is not that big. And if Freddie Mac and Fannie Mae try to reach this goal, they're going to have to take a lot of risk, and it could break Freddie Mac and Fannie Mae, and they're so big, it could take out the U.S. economic system, and it could happen in 10 years. 9 years later, it happened. Freddie Mac and Fannie Mae, huge, what they call government-sponsored enterprises. The only way they existed is the taxpayers guaranteed their debt. Even before they got in financial trouble, they were leveraged 1,000 to 1. That would be like you having a $10,000 net worth and owing $10 million. That's what their leverage was. No private company would ever be able to leverage at that level. When they failed, they owed $5.5 trillion, which, by the way, now you owe as taxpayers. Congratulations. And they had $2.5 trillion of subprime mortgages. They absolutely dominated the subprime mortgage market, and they drove down standards for everybody else because they were the big kahuna in the room. They had a huge dominant market share. Everybody else was competing with them. They kept lowering their standards to meet these affordable housing goals, bringing down the lending standards for the whole industry. Politics played a giant role with Freddie Mac and Fannie Mae. I can tell you that from personal experience. I was on a committee of the Financial Services Roundtable for years trying to do something about Freddie Mac and Fannie Mae, and we were running the numbers, and it was mathematically certain they were going to fail. I mean, anybody in here, 15-year-old, would say, these guys have got to fail. We met with Congress on numerous occasions, and they absolutely would not hear us, even though the facts were overwhelming. Why was that? I think two basic reasons. One, there was just a religious belief in affordable housing. One of the leading components of that is from Massachusetts, Barney Franks. He had a religious belief in affordable housing, so he evaded. He didn't want to hear it. And secondly, Freddie and Fannie were huge political contributors. In fact, they were the biggest single contributor to the Democratic Party and one of the biggest contributors to the Republican Party. So they simply evaded. If you look at the financial crisis, while there are lots of nuances, and I'm going to hit some of the nuances, fundamentally, the Federal Reserve printed too much money to avoid a correction that led to a bigger correction. That correction got focused in the residential real estate market because of Freddie Mac and Fannie Mae and the government's housing policies. It was a particularly destructive bubble because we overconsumed, and most bubbles are overinvestment, but we overconsumed, and that's why we're having such a hard time restoring our productive capacity and restoring the jobs. Let's talk about some other important aspects, background aspects of the financial crisis. One of the more destructive products that was outside of Freddie Mac and Fannie Mae largely was something called a pick-a-payment or a negative amortization mortgage. The way a pick-a-payment mortgage worked is you buy a house, and the monthly interest expense is $1,000. But in the pick-a-payment mortgage, you only had to pay $500. So each month you owed more on your house. And it was particularly bad because you could qualify at $500. So you could buy a much bigger house. These products were very popular in places like Southern California, Nevada, Southern Florida, where house prices have been rising very rapidly. And the theory was go buy as big a house as you possibly can and refinance in 5 years. They were not subprime targeted. They were targeted at people like this room. They were targeted mostly at young people, and the expectations their income would go up, and they were getting ahead of the curve. Turned out to be, of course, a very destructive product when house prices started falling, and people had massive losses in their pick-a-payment mortgages. Guess who the big players in pick-a-payment mortgages? Washington Mutual, Countrywide, Golden West, IndyMac, all large financial institutions that all finance those loan portfolios with FDIC insurance. They could not have raised the capital in the private marketplace. In addition, they got into a vicious cycle. The higher rates they paid on certificates of deposit, the higher rates they had to get on the loans, which is the more risky loans they had to take. And it became a vicious cycle using FDIC insurance. BB&T chose not to offer that product, which is one reason we've done a lot better than most financial institutions. Interestingly enough, we chose not to offer it over ethics, not economics. At the time, you could make these mortgages, you could sell them in the marketplace, and also they had great spreads. They looked like a very profitable product. However, we knew that these were bad products for our clients. We didn't know the disaster was going to happen in residential real estate, but we knew home prices could not appreciate 15% a year for perpetuity, and that we were setting up a lot of young people for economic disaster. And one of the fundamental commitments in our mission is to help our clients achieve economic success and financial security. We expect to make a profit doing it, but something I always tell our employees is absolutely never, ever do anything that you know will be bad for your client, even if you make a profit in the short term, because it will always come to haunt you in the long term. And if you do the right things for your clients, they'll be more successful and you'll be more successful in the long term. And life is really about creating win-win relationships. So we decided not to offer the product over ethics. And I want to come back to that in just a few minutes. One of the interesting questions is how did the federal government, how did the government end up dominating house financing in the United States? That is a very unusual phenomenon. It's not a natural phenomenon. Our housing finance market is far more socialized than Europe. We think of Western European being socialized. Our housing market is far more socialized than the European housing market. Even if you go to a bank, there's a 95% or more probability, even if they make you the mortgage, they're going to sell it to Freddie Mac and Fannie Mae, these government agencies. Freddie Mac and Fannie Mae and FHA, which does 3% down high-risk mortgages that are guaranteed by the taxpayers, have about a 95% market share in the United States. So we have a government-dominated home finance market in the United States. That is both relatively new and unnatural phenomena. How did it happen? And there's some really lessons for today to think about the long-term unintended consequences of government policy. It really started back in the 1960s with Lyndon Johnson. And it's interesting what happened. When I went and got my first mortgage in 1975, I went down to the local savings and loan. You had to put 20% down. You got a 30-year fixed rate mortgage. And at those times, interest rates were 8%. And 90% of the people in America went down to the local savings and loan, and that's how they got their house financed. The success rates of the savings and loans in terms of loan losses were incredibly good. They have very few loan losses. Why was that? First, they knew they were going to hold the risk for 30 years, so they cared about underwriting the risk. And secondly, they knew the market. They understood the local real estate market. The savings and loan industry was systematically destroyed by government policy. Lyndon Johnson, late 1960s, wants to create the Great Society, and he wants to have the war in Vietnam, but he doesn't want to tax people, right? That won't be very popular to tax people. So the Federal Reserve lets that happen and prints a bunch of money. Sound like today? Prints a bunch of money to accommodate the Vietnam War and the creation of the Great Society. There's a long lead time, but in the 1970s, that turns into roaring inflation. And by the end of the 1970s, our financial system's under severe stress because people can't figure out how fast inflation is going to be. Finally, the Federal Reserve steps in, drives the prime rate to 21%. Now, here are these old savings and loans making these 8% fixed rate mortgages. They've been doing it for 70 years, and suddenly their certificates of deposit that they fund those mortgages with, they're paying 16% interest rates on. So they're paying 16%, getting 8%, not a good formula, right? Lots of savings and loans fail. And then they get, the few that make it through that crisis, they get some help from their regulator. The regulator at that time, by the way, was called the FSLIC. The FSLIC costs the taxpayers through their mismanagement of the savings and loan industry probably $300 billion. You know what the penalty was to the employees of the FSLIC that made those decisions? They had to go work for the FDIC. None of them ever got fired. That's what happens to government employees when they make really bad mistakes. In any event, the FSLIC, the regulators of the savings and loan industry, encourage the savings and loans to do something, this sounds esoteric, but to hedge their home mortgage portfolios. Here's the dilemma. You cannot hedge a home mortgage because there's no prepayment penalty. So when interest rates started falling, what did everybody do? They prepaid their mortgage, and the savings and loans lost tons of money on their hedge positions. And then the regulators decided that you couldn't make money in the home mortgage business, which is not true. But they forced the savings and loans to get into the commercial real estate lending business, to finance shopping centers, office buildings, commercial properties. Well, the S&Ls had no expertise in that business. They helped create a commercial real estate bubble that burst in the early 1990s, and then most of the S&Ls that were left failed. Only a handful made it through that cycle. Into that vacuum is where Freddie Mac and Fannie Mae took over the home mortgage finance business in the U.S. Now, here's an interesting fact. BB&T, we were a bank. We could hedge our risk because we also make loans to businesses that have variable interest rates. We would have loved to got into the home mortgage business, but we could not compete with the federal government. Freddie Mac and Fannie Mae are leveraged 1,000 to 1. That means they have the lowest cost of capital. If the government guarantees your debt, you have an advantage, right? So private participants were driven out of what's called the prime home loan market. First, Freddie and Fannie didn't do subprime mortgages. They only did high-quality mortgages, and they drove all the private participants out of that marketplace because they had a huge competitive advantage. By the way, interesting story. I have no empathy for Golden West. Golden West invented the pick-a-payment mortgage that I just told you. But you know why they invented the pick-a-payment mortgage? They could not compete against the federal government in the traditional home mortgage business. So their option was to go out of business or be creative, and they invented the pick-a-payment mortgage. If Freddie and Fannie hadn't dominated the home mortgage business, the pick-a-payment mortgage probably never would have been invented, or certainly would have been a much smaller portion of the market. It wasn't, they don't offer it in Canada, they don't offer it in Europe. It was invented in the U.S. in reaction to compete against a dominant government competitor that had a huge massive subsidy. Then, after Freddie and Fannie take over the prime market, Bill Clinton and government in general, not any specific politician, but politicians in general, put a lot of pressure on Freddie and Fannie to do subprime affordable housing. And so they then become the dominant player in the affordable housing market. Traditional banks like BB&T, we didn't do subprime mortgages, we only did prime mortgages, so they had to find some people to help them. They went to people like Countrywide and Washington Mutual, all large institutions that failed, and they set up these programs so these companies would generate huge volumes of subprime mortgages. And they kept lowering and lowering the standards because Congress had them to have a goal of half their portfolio that they had to meet, or Congress wasn't going to guarantee their debts anymore. So to get the volumes, they lowered and lowered the standards. And they also went into, and they got more broker relationships with local brokers. And what that did conceptually, if you go back to the old savings and loans, or the way a bank makes a loan, you make a loan, you hold it, you care about the risk. In the broker model, you make a loan and you sell it. Well, you don't really care about the risk, right? You just care about whether you can find somebody to buy it. And it leads to a lot of fudging, and ultimately it leads to a lot of fraud. Simple story. An individual comes in and says, you know, I made $75,000 last year, I want to buy a house, when he really made $65,000 last year. The broker says, well, didn't you really make $85,000? Because if you made $85,000, I can qualify you for a bigger house, and house prices always appreciate, and you want to leverage as much as you can. And then a very interesting thing happened. Some of that volume went into Freddie Mac and Fannie Mae. They're taking whopping losses. You as a taxpayer are absorbing those losses today. A fair amount of that volume went into the international market, where these things were what's called securitized and sold throughout the world. These security instruments, what made people buy them is they were risk rated by Standard & Poor's, Moody's, and Fitch. Standard & Poor's, Moody's, and Fitch are interesting entities. They're the only people that are allowed by the SEC to rate financial instruments that are held by public pension plans. That means they have an oligopoly. They have a government-created oligopoly, and again, an unnatural government-created oligopoly. And they're supposed to know what they're doing, right? They have this special certification from the SEC. They know it, and they did an awful job. They misrated a lot of this stuff. That they said it was an A, and it was an F. And that's where so much, quote, toxic mortgages got sold in the market. Bought by hedge funds, bought by pension plans, probably bought by the Harvard endowment or whatever, bought a lot based on this misrated instruments, and took losses in that regard. People say the investment bankers were greedy. Well, and that caused the financial crisis. Well, first thing, I will guarantee you the investment bankers were greedy. I've been in the banking business 40 years, and Wall Street has been consistently greedy for 40 years. But they were no more greedy before or after during the financial crisis than they've been in those 40 years. They're exactly as greedy as they were. If greed caused the financial crisis, it also caused all the good times. It's just the nature of the beast. They were dumb. They did make some very irrational decisions that had some very severe consequences, but they weren't any more or any less greedy than they always were. Let me tell you quickly how that unfolded in the capital markets and what happened. The banks, you've probably heard of CDOs and SIBs, and everybody says your mind turns off. And a lot of people that want to blame it on greed throw that at you and try to make this stuff so complicated it makes like you can't understand it. It's actually pretty simple. a CDO, I'm going to use that as a basic. There are lots of bells and whistles, but the idea is pretty simple. It's called a credit default default obligation, and what it is a way to diversify risk. It started out, a bank makes a loan to General Electric, and it's a $500 million loan. And even though General Electric is a good company, they want to diversify the risk, so they sell $400 million of the risk in the capital markets. Simple idea to diversify risk, actually a good thing. They're looking at the same opportunity with their mortgage bonds. And they've got a mortgage bond portfolio, and I'm just make it simple, say it's rated B. They say, well, you know, there are people that would like to buy A-rated bonds, which are a little lower returns and less risk, and there are people that would like to buy C-rated bonds, which are higher returns and less risk. And the way we can do that is create something called tranches. And the way the tranches work is we decide the C-rated bonds take the first losses, the B-rated bonds take the next losses, and the A-rated bonds the last losses. In theory, the A-rated bonds would never, ever get any losses. That's the theory of the losses. And so they went about selling these A, B, and C-rated bonds in the marketplace, and were making a lot of money doing it. Bernanke inverts the yield curve. So I'm sitting over at Merrill Lynch, and I'm making a lot of money selling A, Bs, and Cs, but I need some assets in my own portfolio to make money in. The only asset that I can make a positive spread in is a C-rated mortgage. Because remember, the inverted yield curve, so I got to hold a high-risk mortgage to get a return, because I don't really think it's that high risk. Remember, it's a C. It's not, not an F. I think it's a C. So what I'm going to do is I'm going to hold the Cs and sell the A's and B's. Then a couple bad things happened. First, the A, B's, and C's weren't A, B's, and C's. They were D's, D minuses, and F minuses. And so when the meltdown started, Merrill Lynch loses 100 cents on the dollars on the C. A year before they went broke, they were making a fortune, selling A's and B's and holding C's, and they go broke very rapidly because they lose 100 cents of dollars on the C's. Another interesting thing in the capital markets is something called a credit default swap. And that sounds very esoteric. This is where AIG was a big player, and I'm sure everybody's heard about the failure of AIG. A credit default swap is also a really simple idea. They've tried to make it a lot more complex. It's just insurance policy. It's a simple idea. I'm at Goldman Sachs. I got a portfolio of B-rated mortgages. I, for some reason, decided to hold that portfolio, but if I can get them rated A, then the SEC will let me have a lot less capital to support that mortgage. So I can raise my return on capital by getting it at A. So all I have to do is go over to AIG, which is a AAA rated insurance company, and they issue me an insurance policy guaranteeing me that bond will not default. And I pay them an insurance premium, but the insurance premium is less than the benefit I get of moving it from an A to a B, or B to an A. AIG does this on a huge scale. They screw up badly. Their own models screw up, and of course they were relying on the Standard & Poor's, Moody's, and Fitch rating system, so the risk is much greater, and AIG takes whopping losses in that process. Now, one of the interesting questions, by the way, is why did we save AIG? It's an interesting question because AIG is a large insurance company, but the insurance subsidiaries were very sound. BB&T is one of the largest, or the sixth largest insurance distributor in the world. We are a huge customer with AIG. We're confident they would not have failed. But there was something called the counterparty risk, and this is the other explanation of this so-called meltdown. The counterparty risk is a lot of people had derivative instruments with AIG. Well, if you're Paulson and you're head of the Secretary of Treasury, and you spent your whole life at Goldman Sachs, and you have $500 million worth of Goldman Sachs stock, and the big counterparty to AIG is Goldman Sachs, you can honestly believe that if AIG fails, it'll take out Goldman Sachs, and that'll ripple down the whole financial system. That is simply not true. It's not factually correct. Regular banks like BB&T had lots of derivatives, and we hedged all our derivative risk. We were doing business for Bear Stearns for whatever, 80 years. We did business with Lehman Brothers. We lost not a penny in either one when they went out of business. Only a few people like Goldman Sachs were really at risk. And if they had fallen, I don't know what impact it would have been, if any, on our economic system. Certainly was not a systems risk. But that whole systems risk argument is just an interesting argument. Or was it crony capitalism? Make your own judgment in that regard. A couple other thoughts about the financial crisis. One is there's a really interesting big myth. And the myth is that deregulation caused the financial crisis. And the banking industry was deregulated during the Bush era. Absolutely not true. We were not deregulated. We were misregulated. The regulatory, you look at all the numbers of the pages in the Federal Register, number of regulations increased exponentially during the Bush administration. They were just the wrong regulations. They were a huge focus on two things, Sarbanes-Oxley and the so-called Patriot Act. Sarbanes-Oxley was supposed to eliminate fraud in the banking industry, but it's a useless exercise in general for the economy. It was particularly useless in the banking industry because we already had a Sarbanes-Oxley back from the early 1990s when the thrift industry failed. So we had a Sarbanes-Oxley on top of the Sarbanes-Oxley.